You will be placed into the conference as a listen-only participant.
Enjoy your meeting. Just a reminder, today's meeting is being recorded.
Hey everybody, good afternoon. This is David Blake with Tuesday Tech Talk. Sorry I'm starting a little bit early today, but I have to get out of here early and run up to New York City for a meeting. So I'm just going to touch base on a few things that I thought were important that we talked about, because the next 2 weeks, Labor Day and the week after, there won't be a Tech Talk. We never do one after a 3-day weekend, but then I'm going to go on vacation on the 20th or the 16th, I think. So what I want to do today was just touch on a few things. The title of this today was Banking on a Recovery, Banking on a Rate Hike. And first I want to touch base on the broader market, a few things I wanted to be aware of, and then we're going to touch base on a few winners and losers if we get a rate hike. So right now, of course, we're still stuck in the summer doldrums. Yesterday, even though we had a triple-digit move on the Dow Jones, was actually one of the lightest volume days of the year. It was even lighter than the Friday before Memorial Day. Volatility remains low. We're starting to get a little bit more action than we did for the last couple weeks. But what we want to keep our eye on at this stage of the month is we want to keep the August 2nd lows on our radar. That's about 18,247 for the Dow Jones, 2147 for the S&P 500, and 5109 for the Nasdaq. If we start to see the major indexes trade below those levels, we'll probably pick up selling and take a little bit more of a downward move. A lot of headwinds coming ahead of the market, coming back from the holiday, and with the election coming up, still a lot of political turmoil out there with CISA stuff, and now the Fed promising to raise rates if not September, December. I still don't think they're going to do it in September, but I think that we'll be well prepared for one in December going forward. Okay, the first thing I wanted to touch base on is the CTI. Originally, we were going to go to a sell about 2 weeks ago with the CTI. In hindsight, perhaps maybe we could have, and that may still be the count. But because of the Brexit low, when we made a lower low in around July 1st, I extended the counts out for the cycles just to take that into consideration, because usually you started the cycle at a low. However, that may have just been a one and done type of deal. So whichever bottom we put in place right now, we basically go to a sell on both models using the Brexit low or the May low in the CTI this week. So unless we would have a big kick higher in the Dow Jones and the momentum index would kick into like a 6 or a 7, we would probably go to a sell in the market. The other model where we made a low in May is still in play. That actually went to a sell 3 weeks ago, and market's down about 100 points over those 3 weeks. So, when the CTI is negative, it means a weak period in the market, and obviously 3 weeks of going sideways is generally a weak period in the market. I don't see any big cracks in the market yet. The volatility picking up here yesterday and today and last Friday, but I do see the NYSE AD line still making a new high, but with the technical indicators, we're starting to see some deterioration in that. For the Dow Jones, we saw the MACD go negative or bearish. That's kind of an intermediate term trend follower. I think the S&P 500 is also going bearish this week. So it's like a 90% chance that it will go to a sell on the market on Friday. Again, I'll be out the next couple of days, but when I get back and run all the momentum indicators, unless the thing spikes up to like a 6 or 7, I'll switch the CTI to bearish. We ended up from the last call from the May 29th calls. If you did the triple leveraged four indexes, as of right today, you're up about 16.5% for for the 2.5 months. So again, we will probably switch those out and go to the bearish leverage ETFs here on Friday, if you're following those things. Okay, again, the cycles aren't an exact science. There's some interpretation in there where you make a lower low or a higher high after you have reset the cycle. So we'll know basically which model we're following probably over the next couple of weeks. But both models, whichever the Brexit low or the May low, we aren't a sell on either one of them. So look for the weakness probably to continue at least into through September and maybe a week or so into October. As far as the sentiment index goes, that's still neutral, so we're not getting any hints on that. But yeah, we'll see where we go. So the first thing we want to look at today is the Dow Jones. Here, real briefly, is the August 2nd low. This is what we want to watch. If we start to break that, that coincides with the 50-day moving average, and that could open the door for a pullback down in here to around 17.9 or so. I believe that would probably hold at that stage. We'll have to see what happens, especially with the election. I think if Trump would start to close the gap in the polls, you might see a little bit more volatility, and you could see further downside, at least temporarily. Okay, the last couple of days, as far as strength in the market, it's been mainly in the financial sector. Here's a chart of XLF, as in Frank is the ETF for that, and you can see this thing starting to made the low back here for the Brexit low, and then we've had a pretty nice rise up into here. And I believe this thing is probably should take off a little bit higher and make a new 52-week high. Now we've been kind of tricked by the Fed about 3 times over the last 1.5 or 2 years. So there's not a big rush to jump in all these banking and life insurance stocks yet. I think the last couple of weeks we've been talking that not for a quick trade, but you can start to build positions in the financials. I still think you can still be building into this. If we get into past Friday's jobs report, and it looks like September is not going to be a rate hike, you may get the fast money coming out, and you can get another chance to add to these financials. I think these are stocks that you probably want to hold into the next year. Okay, now what wins on a rate hike? Basically, you have banks, security brokers, the dollar, high quality stocks, and I'll go over what that means, life insurance, and housing stocks initially. First of all, we look at the banks. Low rates cut in the bank profits. When the Fed raises rates, the banks immediately earn more money. They can raise rates on their loans and capture the difference between the short-term and long-term rates. If you go to the industry group analysis on the Market Edge site, you can pull up the different banking industries. They're broken down by northern banks, southern banks, western banks, like that. So if you grab some of those, pull up the chart and find out you want to buy the strongest banks in those industry groups. The reason you want to buy the strongest ones is because that's if you can look at the 50-day relative strength, those are the stocks that the institutions are buying, and those will probably continue to outperform. Okay, the security brokers will also benefit from a raise in rates, and that's mainly because they're charging more for margin and loans to clients. Stocks for that would be like Goldman Sachs, GS, Morgan Stanley, MS, LPL, which is LPLA, and Raymond James. But even more so than that would be the Schwab's, TD Ameritrade, E-Trade. They don't have a lot of office branches and stuff, so any bit on raising of the rates goes right to their bottom line, and they will definitely outperform if we get 1 or 2 more rate hikes going forward to the end of the year. The next chart I want to look at is the U.S. dollar. You can see some strength. This is from last Friday, where you can see the dollar spiked up over here. Came back a little bit yesterday. We're up a little bit higher again today. We're battling with that 50-day moving average. The dollar will rise as we raise hikes, as we raise the hike. And what you want to ideally, it'll come up here to about this $26 area and kind of stall out, hopefully right around here. We don't want the dollar to get too strong because that can, we don't want our rates to diverge too far from other countries. Otherwise, you'll get too much money flowing into out of emerging markets and back over here. You'll also start to have currency risks on industrials that get a lot of revenues and sales from overseas. So ideally, we get it up to around this range. That I don't think that will cause too much turmoil in the outer markets. The stronger dollar does, however, also go, which we've talked about a lot of times, it hits oil for a little bit, also hits other commodities, and it also can slow down growth in the emerging markets. We've had a heck of a run on emerging markets, but some of the ones like that have had big runs like Brazil, maybe Turkey, and some of these, you might have a little bit of a slowdown in that. You maybe start to think about taking some profits in those areas. But I think this time the emerging markets in general are strong enough to handle a quarter point, and then maybe not another hike for another 6 months or so. So it's not like I would run out and sell all my emerging markets, but I do think maybe you get a little bit of a churn, and before you can, if we put off another rate hike for quite a while, they can start to work their way higher. Okay, going back there again, the next one, high quality stocks and life insurance stocks. Life insurance companies like Prudential, Aflac, if you go to the industry group analysis again, pull up life insurance stocks. This will give you a whole list. It's going to list them by the strongest to the weakest. These are areas that you want to start to build a position in. Again, life insurance companies have to buy high quality debt and bonds and treasury and stuff to keep money for later payouts. The more money they can make on higher rates, the more money that goes to their bottom line. So, again, when you look at the life insurance stocks, I do like the chart on Prudential. Some of these I haven't looked at on some of these others, but get the strongest by 50-day relative strength to the weakest, and that's going to be the stocks that the institutions are moving into right now. Again, even though they've gone up the last couple of days, I think this is a process where you're going to be able to buy these for a longer term. Where here's the industry group right here, where it starts to move up. It should outperform the S&P 500 going forward. Okay, lastly on the winners, I have housing stocks, and the reason I have that, they usually will get a pop over the short term when rates start to tick up. That brings in the buyers off the sidelines, mainly because if you're on the sidelines waiting to get a house, you don't want to see the rates go from 3.75% up to 5% while you're looking around. So if people have been thinking about getting a house, it may incent them to move into the market. Again, if the rate hike is gradually and slow, mortgage rates are still historically really low. I don't think it's going to damage the housing recovery at this stage. Okay, who loses on the beginning of rate hikes? We've already talked about some of these before. Of course, corporate bonds. You can expect about a 15% haircut on your bonds when they start to raise rates. If they're close to maturity, no big deal. You can wait till they mature and you can get out at par. But if you have longer-term bonds, it may be time to get rid of some of those, lighten up with some of those. If you're retired and you're older, if you're like my dad who says, well, I need the income coming in, I have to constantly remind him that if he has a $100,000 bond and he takes a $10,000, $15,000 haircut on that, it takes a lot of dividend checks to make up for that $10,000, $15,000. You're probably better off to sell the bond, and if you need some cash to come out occasionally, go ahead and take it out of your principal, and you can always, until you find another bond that you can extend the time period out, and you don't lose that bit of principal. Okay, on the emerging markets, again, what happens with that? They pay higher interest rates, but if the U.S. diverges too much, and you start getting a better return in the U.S., money from those emerging markets starts to flow back into the U.S. and slows down their growth. So I don't think you're going to get a big hit in the emerging markets, but the gains in the emerging markets at this point could slow down because a lot of these, some of these stocks are up 20, 30% for the year to date. Another loser would be oil. But again, on oil, you know, one rate hike or so is not going to knock it back down to $30 a barrel. I do think you go sideways for a little bit of on oil. You'll kind of churn a little bit. And if the broader economy is actually improving as much as they think it is, that's good for oil in itself. So that will eventually start to have oil work its way back up towards that $50 range. Okay, lastly would be the rate-sensitive stocks. The last month or so, we've been talking about the utilities. We thought we'd start selling off the utilities here about a week or two ago. Utilities are down right now about 10% over the summer. I think you know, if you have utilities, here we are the chart on that. We were talking about taking profits over in here. I think this thing goes a little bit lower. You could get a move down into this area you know, fairly soon if we get a rate hike. Reason being because people are going to get the dividends become less attractive on some of these stocks. The other one that we've talked about a little bit is consumer staples, and I didn't get the chart up on here, unfortunately. But consumer staples, we've been talking pretty much we would be a hold on the staples until rates started to rise. I would start to lighten up, continue to lighten up on the consumer staple stocks, mainly because that group is trading at about 23 times earnings, and historically they trade about 12 or 13 times earnings. And I just think that when they start to go, or if the market would start to roll over, those would be some of the stocks that the institutions and hedge funds would begin to lighten up on that. I wish I had the chart up here. I didn't get it. I can't do it. But there's actually a head and shoulders chart on the consumer staples. That if you look at that pattern, it looks like the consumer staples could probably trade down to about $50 on the XLP as in Paul, and we're up there around 54.40. So I think you could probably get about an 7 or 8 or 9% pullback on the consumer staples stocks. Today they're down almost 0.5% today, and utilities are actually down another 0.6%. So those are the areas that you know, where you want to lighten up. The financials, I think they should do well in here. The technology still looks good. Consumer discretion is kind of a little bit choppy. You're either a big winner or a big loser in that. But I don't have a problem holding those stocks if the economy still looks good in here. Okay, I apologize. I'm going to have to wrap this up at this stage. Again, I have a meeting in New York late today, and I didn't realize that my plane was going to leave from Atlanta this early. So if you have some questions about this, it'll be up on the website in about a half an hour or so. If you have some questions about it, please feel free to send me an email to dblake@marketedge.com or the doc@marketedge.com. I will be. There won't be a tech talk for the next 2 weeks. One because of Labor Day, and then I get a vacation after that. So, again, I apologize for making this such a short one, and I will get to your questions on here and get back to you later on. And that's it. Thanks again. Have a good, safe Labor Day, and I'll talk to you in a couple of weeks.